Hello and welcome everyone. My name is Kelsey and I help in running events and programming at Rise New York. Thank you for joining us today for our webinar on machine learning and AI, an investment perspective. It has been amazing working with the Boosted.ai team on this event, and I want to give a big thank you to them. In this discussion, we will explore the nature of machine learning, of the machine learning market, and how these technologies are changing every industry in the world using investment management and credit underwriting as prime examples. This panel will be moderated by Julie Greenberg, who is the co-founder at Fintech Today. I will now pass it off to her so she can introduce herself and the panelists. Thank you for joining.
Thank you, Kelsey. Excited to be here with you guys again today. I think the last time I moderated something for you, I was still in New York. I think it was the summer, something like that. So it's good to be back again. With me today, we have Josh, the CEO of Boosted.ai. We have Dan, founder of gravityAI, who has a very nice setup over there with a mic and everything. Melissa from FinRegLab, and Jeremy, Executive VP and Head of Research at WisdomTree Asset Management. So thank you to everyone for joining me today. I want to kick off with Melissa, because something I think is very timely on this is we've seen some new regulatory crackdowns come out on how companies and different industries are able to use AI. I know when we were doing our little intro call, so we could all meet beforehand and whatnot, that you mentioned an article in the Wall Street Journal where the headline is "Artificial Intelligence Facial Recognition Faces Curbs in New EU Proposal." So it sounds like, this is an example of something going on in the European Union, but they are far from the only nation that is looking to make sure that consumers like me, you are not exploited by the way companies are using AI. From your perspective, what is going on here and what should we be watching out for? Do you think more of this is to come? And what do you think is the future of regulation in this industry?
So Julie, thanks so much. And it's a pleasure to be joining you all in this conversation. If you don't mind, I'm going to take just a second. I don't know that all of the viewers, listeners know who FinRegLab is, so it might be helpful context. FinRegLab is a DC-based nonprofit research organization that I established after leading the Office of Consumer Policy in the U.S. Treasury Department in the Obama administration. And the punchline, the really quick punchline is we, at the Treasury Department and the administration, and frankly across government agencies, including financial services regulators, financial sector regulators, we're being bombarded with arguments of how technology and new types of data were either revolutionizing the way that the financial system works, or we're ultimately going to take down our global financial system because of all the risks, the attendant risks. And what we did not have was any independent source for actually undertaking a non-advocacy look, an empirical look and evaluation at how particular data or particular technologies, when deployed in financial services, would ultimately affect people, real life consumers, all of us on this call, how data or technology in a particular use case would affect market practices and the broader market context overall, the financial sector context. And ultimately, really importantly, how are we going to evolve our laws and regulations so that we really are maximizing the benefits that can come from data and technology use while making sure that we are minimizing the risks and the harms. And so that's what FinRegLab has set out to do, and we've been doing over the past 3.5, almost 4 years now. So that gives hopefully the listener some sense of where we're coming from. If there was one true north, if you will, to the work that we do, we are especially interested in how data and technology may help to ensure that everybody, all people, small businesses and communities are able to access safe and affordable financial products and services. And if you think about the many ways that the financial system, which is all about risk assessment, which is all about data, which is all about understanding, are you who you say you are? Are you going to pay back this loan? Is this trade a smart one to make or not? that all comes back to really being able to maximize and use data to its fullest potential. So yesterday's headlines were not a surprise to, I think, many of us. The EU began many years ago thinking about data and people's needs for data privacy and protections with respect to data. Data isn't just sort of a thing in and of itself. It gets put into very what I like to call fancy math and the computational power that gets applied to it. And it creates lots of opportunities, but lots of risks when data is used that way. And so I think what we're seeing out of the EU is very much a process that's been unfolding over the years to really make sure that the potential attendant risks when we don't have the right governance of AI and the data that are being deployed, that we really sort of help to protect against many of the risks. And to be fair and to be clear, the EU's announcement isn't just about the use of data and AI in financial services. It is across the board, the application of data and technology in all sectors, policing, and the list goes on.
Dan, I saw you shaking your head in agreement while Melissa was talking. Do you have anything to add there?
Yeah, I think that there's a lot of talk, particularly as you mentioned, within government agencies about how we regulate this, and the trouble is that it's very ambiguous. We don't actually have the answers yet on the appropriate way to do that. There's many times where best intentions, when and I don't even mean in regulations, but best intentions in data collection for AI actually result in negative outcomes for individual citizens. A great example of that is, one type of bias that could be inherent in data is systemic bias. And that's not anything wrong with the data itself. It's just that there is systemic, what is reflected in society actually finds its way into the data. And there's a great use case where data was collected on ethnicity, really with the goal to combat this systemic bias that might be inherent in the data. But of course, what happened was that, this data that was additionally collected was used for, bad purposes. So here's a great example of where, how do we regulate something where even the best intentions could be used for nefarious purposes.
Yeah.
Jeremy, what about in the ETF and investing space? Because over the past year or so during the pandemic, when people were not able to gamble on other things, they've been rushing into stocks and other ways to trade. And I feel like because of that, like we've had the GameStop hearings with Robinhood down in DC. So this is an area where I feel like regulators are taking a close eye on. Is AI a part of that at all, or are they focused on other areas in your mind?
So, WisdomTree, we are a ETF manager. We create quantitative rules-based strategies. We've been doing that for the last 15 years. And a lot of them were very simple, we rebalance once a year back to fundamental streams like earnings or dividends. And, you have very simple, understandable screens. We are definitely trying to push the envelope ourselves with things, as the world has become more complex and you think about what is AI, it's really just an algorithm. It's it's a fancy term, but it's assembling data, looking at it, applying some software techniques to get smarter and learn and not just have human learning, but actually have the machine try to improve the process and find things that a human mind wouldn't have seen. And you're at the sort of very early stages of this today in the ETF world that I operate in. There has been a few ETFs, one from a Korean-based firm, sort of AI fintech firm. They've got 3 or 4 ETFs. They've been performing, really well in the marketplace today. There's been some new sector rotation funds that have been in the market, and we're studying getting behind a whole suite of these type of offerings. I wouldn't say it's bubbled to the regulators from any perspective. I mean, I think you are seeing the approach in ETFs is trying to get more active. I mean, you see that story. You see some really popular active funds, concentration risk in some of these active funds. So it's a different, I think, a different issue in ETFs, but I think AI algorithms are really what indexing and ETFs were meant for. So I'm looking forward to trying to do more work. The Boosted.ai team has been a really interesting provider. They have a lot of interesting tools to understand what's driving. I think that the hardest part of AI, to some of Dan's points and Melissa's points, was, do you know what's driving your results, and are you intentional about it? And I think that's one of the challenges some of these other AR firms is they have no idea what's driving the results, and so that you can control what goes into a model, what comes out of it, you could explain it to people. Those are going to be some of the key challenges investors care about.
Josh, I see you, looking like you want to chat about this as well. From your perspective, since you guys help WisdomTree and other, investment professionals, what are the biggest things that they need your help with? I think Jeremy alluded to some of that with, hey, like, we're using this, but like, what is actually driving our results? I think that's one, but I'm sure there are others that you find, they're consistently looking you to help them out with.
Yeah, so I maybe even try to take it back to the sort of regulation standpoint. It hasn't bubbled up to the level of regulators, and I kind of don't think it will. But there is kind of a general consensus. There seems to be a general consensus that machine learning techniques are largely going to be a big part of the future of active management and stock prediction and risk mitigation and things like that. But at the same time, there seems to be a trend across a lot of allocators where they're not just sort of accepting of the idea of a black box. They kind of want to understand, what is driving the model? Why is the model making the decision? What are the risks of this particular model? How can I mitigate against those risks? How is it done historically? And then using that to get some sense of the types of environments where these systems are going to do well and the types of environments in which these systems are going to not do that well. And, I would suspect as retail investors get more sort of savvy and sophisticated in their analysis of these things, they're not there yet, but I'd say over the next 5 or 10 years, you might start to see sort of similar questions being percolated as people are starting to make allocations. Right now we're in the spot where machine learning is a very hot topic and it's at the earliest forms of adoption. So there's just a lot of excitement around it. But I think as it sort of standardizes over time, some of these things will start to become more important. And so jumping back to our product, a lot of what we help with is the sort of process of building predictive models using machine learning, but doing it in a fairly safe fashion, doing it in a way where your live performance is going to match your back test, where you can kind of understand the inputs and the outputs. And also, really, really importantly, try to take some of these sophisticated nonlinear connections that the machine's learning and explain it back in a way where the human can understand it. And that, that's a very daunting task. We're kind of right at the frontier right now in terms of what that technology is capable of. But I think it's been really exciting kind of seeing the model interpretability over the past 2 or 3 years. I think it's starting to make some very, very large strides to the point where you could start thinking about capturing other things beyond just, what's the model doing, but you could start to analyze systemic bias and other things too, if we're talking about more traditional machine learning.
Jeremy, I'm going to throw it back to you here. So a lot of these techniques have been developed since the financial crisis. And ever since then, we've been in a pretty good bull market with some pullbacks here and there, like when COVID started, et cetera. How confident can people be in certain techniques that are working really well right now that they'll continue to work? And how do you guys think about that?
It's really no different than any other investment strategy. I mean, when WisdomTree was born in 2006, I'd worked with Jeremy Siegel at the University of Pennsylvania, Wharton School. He wrote a book, Stocks for Long Run. I helped him on a book, The Future for Investors, came out in 2005. It was all about value investing and, the tech bubble, the aftermath tech bubble. How do you solve for that? We had 50 years of data going back to the S&P's foundation, and he said high dividend yield stocks outperform low dividend yield stocks, low PE stocks outperform high yield stocks. You write the book, and then 15 years later, all that works is tech, like large cap growth, expensive stocks. Based on 50 years of research, the market environment changed. Now, I think it's getting even more important to think about value. But it's no different than any type of factor investment strategy that you do it based on historical evidence. The more the data, the longer the back test, the more confidence it gets you. But I'd say, so yes, there's some shorter windows available of these new models, and you can only be able to see it in hindsight, but you have to put it together in a way that makes sense, that you think the underlying drivers will be predictable, that there's some underlying intuition. I mean, that's to my point, the explainability is like a key factor. Is like, what is the intuition for these things working at a macro level, at a stock level? Are there different factors for an individual stock versus a broad stock? And that's where the machines can pick up things that, you know, maybe you had a broad systematic strategy that only looked at dividends, but there's a lot of other factors that matter. I mean, that's to me the excitement. But yes, the windows are going to be much shorter. But I don't see this challenge being any different than any other investment strategy. Just you got a new way of coming up with the inputs.
Melissa, is there any reason to worry about a systemic risk here from a regulatory standpoint?
Sure. I mean, I think one would never say no, you know, because do we ever really know what's on the horizon? I was going to actually sort of jump onto what Jeremy was speaking to and frankly pose a question because I think it's hopefully helpful. We're coming very much from the retail side and the deployment of machine learning algorithms, and we are doing a deep dive, frankly, I think, first order question, which is, which of these algorithms are explainable? And depending upon what data you actually plug into them. And again, we're looking at sort of what many would argue an important sort of high risk area, which is the deployment of machine learning algorithms. And I'm talking about more opaque algorithms than regression in credit underwriting, consumer and small business credit underwriting. And we also have put together just so you have the context of how we're going about this, a 40-person advisory board consisting of the big banks, big tech, Microsoft Research sit at that table to help inform what we're doing. So we're talking to the banks, the regulated entities a lot. We have fintechs that are a part of this too. We've seen fintechs being a little more willing or even bold to use more opaque algorithms. We see the depositories as being more conservative about the particular types of algorithms that they're willing to deploy. And I'm actually curious if you all see in the areas that you're looking at machine learning, some caution and real intentionality about the algorithms that are being used, what's sort of more explainable. And then we're even seeing institutions that won't use algorithms that they're not building from the start as explainable AI. So just curious if you all are seeing that too. I'll keep pondering your question about systemic risk. I mean, you know, I think there's systemic risk as you think about also back to the data that are being plugged into these algorithms for the different purposes. I mean, we had a massive event, i.e. COVID, and what that has done to the data that you are plugging into your risk assessments, radically different, right? Was there a potential risk there? You know, not so far, but you always want to keep your eye on sort of big events and how they might have some systemic implications.
And Josh, you had it first. Go for it.
Sorry. I'll just say from our standpoint, there certainly in our early days, there's a lot of hesitancy for some of the newer techniques, but you know, there is a very definable difference in the performance between some of the more opaque models. You know, if we think about deep learning or tree-based models versus some of the more easily explainable models, such as linear regression. And so from the earliest days, actually a big part of our tech stack was, you know, we don't want to lose the performance of some of these more sophisticated, harder to understand models, but we also want to somehow figure out ways to make them interpretable. And so that's been a big area that we focused on, but it's actually been kind of interesting because one of the areas in which we sometimes add values is a lot of times in some of the big organizations, the sort of fundamental teams, the guys that are going out and doing this direct research don't really connect or talk very well to the quant teams, the guys who are building these opaque models.
Absolutely.
They're often kept very separate.
Yeah.
What's really interesting is when you can start to build interpretability into some of those types of models, it actually makes it easier for those two teams to communicate, collaborate, and ultimately for them both to become additive and create some synergy between their processes as opposed to being somewhat separated. So I'll just say, yes, it's a big concern in the financial industry, and I suspect it's everywhere. But I'll also say the sort of science of analyzing and interpreting those types of models is also advancing fairly rapidly. It's still a little bit behind the curve versus where everything else developed, but it's getting there.
Yeah. I think there are even big debates inside large institutions about sort of who's in charge, who's really thinking about, which of the models we're using, what sort of, does the first and second line of defense really still hold? What's the governance around them? It is creating, I think, real conversations that need to be happening about how do you safely deploy algorithms, especially those that are more opaque, that are then harder for those who are not the computer scientists and data scientists who are building them to really understand it, because they're the ones who are going to be on the hook with the regulators. So,
yeah.
It's such an interesting point, because data science is really a team sport. Like, it cannot, and for a long time, Melissa, you just said, the data scientist is on the hook with the regulators, right? But there's so many different things that actually go into the creation of these models. And, so gravityAI, we're a marketplace for these models, and we have things that range from the highly interpretable types of models that exist within the marketplace that have interpretability built into them, to those opaque neural nets. And what we're really talking about when we're talking about the concern for not knowing how a model is, the opaqueness of it, the non-interpretability of it, is there a substantial risk that the model is going to make a decision that is negatively impacting society or an individual? And the question is not always, is this model interpretable, but how do we bring together a kind of interdisciplinary team to review the ultimate output of that model,
or to build the model in the first place?
Yeah,
right.
Exactly.
I mean, all the way down to what are the data that you're plugging into it to begin with to train it on. Yeah.
I keep hearing these, these talks saying, like, data scientists need to become experts in ethics so that they know how to, formulate the right way to build these models and review the data. And I think, there's people that go to school for years around this. You should probably just hire an AI ethicist as part of that core team to help make sure that the right way to think about that is being included. And when I talk about it being a team sport, that also means that you don't necessarily set a model to run without anyone overseeing it. Oftentimes, we go through a process for our models where we have a technical writer and AI ethicist on staff, and we make things like human agency recommendations. So should a human be in the loop for this process? And for something like credit underwriting, yeah, probably, there's some things that can certainly be automated there, which is ultimately the goal, but there should be some sort of understanding of when human agency needs to interject, when we don't have a certain confidence level in what's being delivered, where someone checks those results. And again, that's where the interpretability comes in. There is something fairly interesting, though, within the concept of interpretability and explainability that's much more interesting on the investment side, which is the explainability paradox. The more explainable the model, the more at risk it is for being tampered with, because that means that people understand the individual factors that are going into that model. And while we can clearly point to, XYZ is contributes 30% of how this model makes its decisions, well, that means that XYZ is also being subject to potential manipulation, either by malicious attacks or by just another investor catching on.
That's really interesting.
Yeah, I'd never thought about it that way before. How do you manage that then? If, like, obviously as a consumer, I want to make sure that I'm not being, like anything malicious is happening in terms of credit underwriting or other ways that AI is being used when it comes to me. But I also wouldn't want the company that's using that to have my data stolen because they understood what was in it and how to hack it or something like that. I've never thought of it in that angle before. So that's a really interesting point.
Yeah, I'll let Joshua and Jeremy jump in on this as well. The core risks right now are less from individuals that are trying to mess up your model from like just contributing data. It's much more from like, is someone making a malicious attack on what we're trying to do? And ideally, it would become pretty evident that someone is trying to manipulate your data. So, but it's just something now that companies have to be aware of. If I can say that, you know, the core factor in my investment strategy is, I don't know, sentiment analysis, that opens it up to someone, you know, creating a bot to say that GameStop is suddenly, you know, frowned upon by the entire community, right? And then that affects my model, and incorrectly, because someone's manipulating that data that I'm ingesting.
Yeah, so I'll say it's kind of interesting in finance. There's sort of there's kind of three parts really. So the first thing is, you know, is there bias in your model? What's it learning from, and what's driving it? But ultimately, you're actually often trying to sort of eliminate bias. Your goal really is to try to create the most idiosyncratic signal that's the most successful in an up market or in a down market. You want something that's not going to get hit by factor rotations. That's not going to get hit by, you know, a sudden GameStop retail spike. You want something that is fairly diverse and can handle kind of a wide variety of market conditions. And so, since that's already kind of your goal, I think it can help fight these things that Dan was referring to a little bit. And I'd also say, you know, we kind of break the problem into two parts. So to take 3 steps back, we have a platform that's basically designed to make it easy for investment managers to incorporate machine learning in their process. You come in, you kind of give the system the data you think is important. You tell the system what you're trying to predict. So what you're trying to predict could be alpha, could be earnings, it could be, you know, finding the companies that are most likely to see a spike in volatility, whatever. And then you take those things and you ultimately build them into a portfolio. And so we actually separate the process of sort of your signal generation, figuring out what are the set of stocks I maybe want to buy and the set of stocks I maybe want to sell, from portfolio construction. You know, your portfolio construction side is where I'm going to come in. I'm going to maybe try to minimize the volatility of the basket of stocks I've picked, or I may be trying to reduce my exposure or you know, increase my exposure to something like oil, momentum, or other kinds of factors. And so really the advantage of the explainable part and the advantage of being able to sort of analyze your portfolio is that we can actually take these different risk factors and mitigate them. That's kind of the whole point of the exercise. And so I would concur and agree that it is somewhat of an issue, but there are ways to tackle it within the sort of financial portfolio construction apparatus.
Jeremy, what do you have to add on that?
I was thinking about going back to one of the earlier points. I mean, I think the key in all these models is how much data you have that goes into them, right? I think like there's like even talking about like what in terms of who's going to be the top leaders in AI. We were talking about risks from AI and a little bit of the regulatory risk. I don't want to make it too political on some of it, but there is, if you say what is one of the big battles over time, I actually think it's like US versus China as you know, the tech stars in the US versus the tech stars in China. And there's a view that, you know, China just has more people, so they have a lot more data and they're sharing it a lot. And you saw some of the sanctions last year, so companies that were prohibited from investing in. China is doing a lot of this big data analysis and even going towards like grading everybody, getting a social score, and it can be used in a very different way, but they have a lot of data. And I think the China tech versus US tech is going to be one of the big stories we focus on over the long run. And I think China is going to be a leader in some of these AI things. But I think that's just an interesting angle of that risk factor that we were talking about, is as what is the overall risk levels and what is the risk in some of these China companies that has been, you know, very front and center in the politics side.
You know, I love that. I was planning on asking, there was someone that mentioned like the ethics around all of this, and then someone just posted in the chat my example that I was going to use. I remember a year and a half, 2 years ago, when that whole Apple Card Goldman Sachs fiasco happened, where Goldman and Apple didn't like women because they weren't offering them as much credit as what their spouse is. How do you explain that? And is there an ethical issue with that, or other things happening in the industry? And what can people using AI do to make sure that that's not happening? Melissa, I'll let you take this one first, because the first question
there's a lot there. Okay,
I'll
because everybody's going to want to chime in on these, and I'll start with my favorite, which is the Goldman Sachs Apple Card. I think I think we all need more facts to understand what happened there, including understanding what the laws are in terms of how individuals versus households are evaluated for credit card. Lenders can't evaluate individuals in their own right. And I don't know how Apple and Goldman did it. Frankly, I don't even know that. I don't know what underwriting methods were being used in that credit card. So I know people love to jump on that. I know it feels really painful, you know, that the spouse, the wife was offered, you know, a different credit than the husband. But I just think let's get our facts. And at some point, I'm going to write an op-ed on this, and I'm going to get the facts first before I do. So I'll be coming back to you, Julie, when I have that ready to go.
Please do.
But the ethics piece is a big one because, you know, we've just come out of everybody's attention over the past year about the racial injustice and the inequality, economic, racial inequality. And thank God everybody's attention is focused on this, frankly, more so than has been in the past, because we sure as heck want to make sure that the AI and the machine learning we use going forward does not bake in and exacerbate the differences that are there. And not all of them will be solved in the underwriting models we use, but making sure that we are as intentional about how those models are developed, the diversity that's required in terms of the design of the models that are used, the data that are used, the calibration about what you're learning on the outside, and ultimately what you deploy is, you know, again, our focus is on the lending side is really, really important to making sure we get this right. And then sort of going even one level higher, you know, the reference to China and their very aggressive stance on all types of data that they have been willing to use and put into things like social scores. I totally hear you, and I generally join. We need to understand where data can be advantageous for purposes of, you know, making sure that we are better able to bring more people into a safe financial system. Having said that, you know, when we think about, let's separate out the analytics, the algorithms that are used, and let's think about the data questions. Do we have consumer consent when we're trying to bring in these new types of data for evaluating somebody for, do you get access to a financial product or any other product for that matter, right? How do we make sure that we've got the governance around the data and the privacy protections in place so that then, you know, when data are being used, it's with consumers' knowledge that that information is being deployed. I'll just point out, I mean, one of the areas that the EU position on regulating AI, what they call out is this notion of these credit score or these social scores, that kind of thing, high risk and may actually be prohibited. So how does the EU, I mean, it is a good question about globally, what do these large countries and governance blocks, sort of what positions do they take around what's allowed and what's not allowed, both in the AI and the deployment of it, but also in the data and the protections and the setup around data privacy and consent that follow. And here in the US, I mean, we saw California follow the EU with a data privacy law. Will we see something akin to that, to what they're doing in Europe now on the analytics side? Don't know, but that would definitely play in, I think, Jeremy, to some of the things that you're, you know, thinking about in terms of what's going to be happening next.
I mean, consumers often like, you know, I mean, you think about how much we share with all the tech, we interact with tech. We have, you know, we bring in Alexa to the house. We bring, you know, Amazon's next products to buy. People like, I mean, and in fact, when I work with my financial services, I actually wish they were more integrated. Like somebody turned me down for a credit card because I had a $30 bill that somehow lapsed during COVID that I couldn't even figure out how to pay it. And, you know, you're like, they should have better data. They have my bank account. They like literally are my prime consumer. They see how much I get paid out every week and they turn me down because of some crazy bill. Yeah. But I mean, so consumers often, It's interesting what consumers would opt into versus opt out of, and I think some of that is making it transparent and giving people choice. I think would be useful, but it does seem like the big tech companies, because they have, it's sort of this self-fulfilling feedback loop where they have a lot of data, their algorithms get better, it becomes harder and harder to compete with them because they already have that embedded infrastructure. And then I think you see like the new financial services versus old, it's tough for the financial services to keep pace with that.
Well, if I can jump in on that, I don't want to take up too much of our precious time, but what is really interesting to me, and it keys off of your point, Jeremy, is in financial services, especially in areas like consumer financial services, we have explicit laws that require explainability. And we have explicit laws that prohibit discrimination, either explicit or implicit discrimination. And there actually have been positions that federal regulators, the Federal Reserve Board has taken, that the Fed has given a signal to regulated banks: if you are going to be engaging and partnering with large advertising companies for marketing your financial products, you need to make sure you know how those large technology companies, advertising companies, i.e. Google, what data they're using, what are those algorithms that they're deploying, and you need to make sure that you're not seeing or creating a discriminatory outcome, a disparate impact effect. And I've been intrigued both by the fact that we actually have laws that govern the financial services sector that I think are potentially good models for how we think about governance of AI and data in other sectors. But even this relationship, when you've got large banks who may be wanting to market through Facebook or other large advertisers, that there is this requirement, and you have to wonder how the banks then sort of define expectations on a Google when Google is the facility for marketing around financial products and services. It doesn't go the other way, obviously, and that's some of the questions that people have about, should we be thinking about governance of big technology and how they're deploying data. And Jeremy, I get you. I have a debate between my house, where my kids are with me half time, and my ex-husband's house. I have no Alexa in my house, but when the kids are over with their dad every other week, they've got the Alexa. So how consumers, how we feel about these matters, it does often come down to the personal.
In regards to the way that we think about our data as it's used across the web, so every single person right now has something that's called a digital ghost, and that's essentially the aggregation of certain digital data about you that exists from your browsing behavior to whatever is, from Google or Facebook, that Melissa, as you mentioned, that these financial industries are not directly understanding, but leveraging through these other advertising platforms like Facebook and Google. And I think in many ways, particularly like something in like Facebook's case, they don't fully understand, I'm guessing, where all of your data actually exists across the spectrum of your digital ghost and how that was all formed. Personally identifiable information is often deeply hidden in various databases, as well as other not necessarily identifiable information about you, but certain things that lend itself to criteria about how they would make a credit card offer, for example, in the example that we were bringing up. That data is often hidden in these massive data sets. AI and models and big data created this problem. Fortunately, we're working on different types of AI that can help solve this. There's different types of PII detection models that can uncover any kind of PII data that's hidden in databases so that companies can be compliant with things like GDPR and CCPA. I'll give a shout out to a startup that I'm familiar with. Manitou actually has built a platform that allows, if you're integrated with it, a consumer can go in and see how their data is being utilized and control their own data within a company's infrastructure, delete it, correct it. Actually, one of the big selling points for them is that you can, a consumer can actually correct data, which we'll see if consumers actually will ever do that, but that might be helpful for a large enterprise. But these are the types of things that we're seeing where it's starting to allow people to kind of take control of that a little bit more, with hopefully positive outcomes for both the enterprise and for the individual.
Yeah, no, I think that's a really good point. Moving on to another portion of this, another way to apply AI is through things other than investing in credit underwriting, but still related to this space, which would be, client sales, like which clients do we reach out to next, and sort of automating some of those processes. Josh, do you want to talk about this first a little bit?
Sure. I mean, so there's a ton of stuff. Which clients do I want to talk to? I think one thing that we've kind of studied internally too is just measuring user engagement, who's getting the most value, who's maybe not getting as much value out of it. Making predictions about sort of which features and value in your product are the most useful. What are some areas that you need a little bit of development? I would argue that good data has privacy issues, but used well, it can actually be leveraged for the social good. Just to talk about some very specific products, even outside of us, Google and Bing and a lot of modern search engines are built on the back of click-through data. So they're literally looking at your interaction with the search engine and using that to decide which results to show you. I would argue that it is a much better paradigm than, say, AltaVista, which was using purely a content-based approach. So anyway, taking 3 steps back. Yeah, it's the data can be very valuable in terms of making predictions about clients and other things surrounding the investment space. It can be used, around for us, portfolio construction, risk mitigation, stock prediction. I think one really big thing in 2020 was that a lot of traditional risk systems kind of broke down. If you think about momentum as an example, traditionally, in most downturns, you'd actually want to get out of momentum and you'd want to go into something like growth. Well, in 2020, momentum was by far the safest thing that you could be holding. And if you held growth stocks in March, you probably got destroyed. November 3rd or November 4th, the vaccine announcement came out. And again, you saw this whole other factor rotation. And again, it was a really bad month for a lot of quant systems. What's really, really cool about machine learning is you can start to measure these things as kind of a mosaic. As an example that SPG is related to shopping malls. Shopping malls are related to social distancing, and that's related back to COVID. That CCL as a cruise line is related back to Zika and other pandemics, and that gives you a path back to COVID. That fitness equipment has some connection into it. And so all of a sudden, these things have never connected. I think never in the history of the stock market has fitness equipment, shopping malls, and retirement homes ever been sort of correlated as one risk. And so if you're using kind of a traditional quant system, you probably had a lot of trouble capturing that. What's really cool and really exciting about some of these newer techniques is they can actually find these long range connections and sort of risk mitigate against it. And that's been increasingly important in 2020 and going into the beginning of 2021. So sorry, kind of a broad shotgun shell there, but just a lot of applications of this technology.
Yeah, and Jeremy, how do you guys use it at WisdomTree?
Yeah, we were, I think, maybe one of IBM Watson's first clients to not use it from just purely an investment side, but to do it from a, how do we use it in like the Amazon next product to buy, next client to call, but maybe not even call. Maybe the data actually said they'd rather be emailed, and figuring out how you communicate with people and what you do. So we've definitely been investing in this and have built up our own data science team internally that looks to do all this and create from interactions on the website to then who's the sort of scoring leads, and just sort of like you're scoring stocks with Josh's system, we're scoring, we've got all these email addresses, people who've been on the site, they've registered, they're looking to that engagement point that he said. You have an algorithm to give the sales team who should they be calling or emailing, or and so that has been a great way to engage and make get better at all that. We have some dashboards of what products that we have that are likely to be inflows and outflows, and then you can try to then address that, right? You can take actions to say, here's what the model is predicting, here's what our model is predicting our revenue is going to be based on what's the growth going to be, and we're looking at it every month. We just had a meeting yesterday. Here's the inflows and outflows we're projecting. What can we do to overcome it? And so we are using that type of analysis. I mean, we started interestingly on the business side before we got to the investment side, but I am excited to try to do it from the investment side increasingly, what Josh was just talking about.
What about, I'll let Dan take this one first. What are your thoughts on, and this is a question from the Q&A. Thanks for everyone for submitting stuff to keep coming in case there's probably have time for a few more as well. So it says, talking about data, what do you think are the implications of selling data, and what are your thoughts on pricing data?
This is a really interesting question. I mean, data selling has been happening for a very, very long time. You know, I remember actually back in the heyday of ad tech, you know, before there was this big kind of fraud thing where Johnson & Johnson pulled like $1 billion of advertising from the net. You had an enormous amount of startups and larger companies doing data brokering back and forth. I think what we're seeing now for the first time, and there's a couple, I'm aware of actually only one company doing this, but we've talked about data as the new oil, but it's very difficult to actually put any sort of direct value on data. So data typically, where does it fall on a balance sheet? How do you actually think about it in terms of how you, is this something that we can actually leverage, you know, get a loan off of, based off of the data that we have? Is this proprietary data? And there's actually a company, Agori, right now that is working on this very problem, which is how do we actually formulate data as an asset that might fit on our balance sheet? So the short answer is it's very difficult to understand the pricing of this, but the factors that typically would go into that is how proprietary is this data? Is this something fairly unique to me? The more proprietary the data, typically the higher value that data is, right? Because it's scarce. Other people don't have it. Other factors would be what type of signal, you know, it doesn't matter if this data is super proprietary if it's not anything that I can derive any kind of signal out of, right? And that signal doesn't even necessarily have to be investment signal. As we were just talking about with marketing, it could be, you know, is this a worthwhile signal that helps us understand whether or not XYZ audience is ready to buy this type of product? Those are the kinds of things that go into pricing data. I actually think we're moving right now into the next phase of how that's all going to be managed.
Josh, do you have anything to add on that?
Yeah, so I'll say in the finance space, there's been kind of an explosion of alternative data. Something like 55% of hedge funds are using what you call alternative data. Now, when I talk about alternative data, I mean things like credit card data, geolocation data, things like the movement of aircrafts, you know, things that are different than traditional data like balance sheets and momentum and things like that. Something like 55% of hedge funds today are using it. Something like 9 out of 10 of investment managers believe that alternative data needs to be a key part of their process going forward. You have a few hundred times as many data providers today as you did a decade and a half ago. And the sort of size of this industry is expected to grow something like 10x over the next decade. And that's saying quite a bit. It's already a $1.7 billion expenditure. So you have this massive explosion of data. What I think a major challenge, as Dan sort of alluded to, is it can be very difficult to figure out what the value of this data is. And a lot of more fundamental firms, you know, if you go out and you buy a gigabyte of credit card data, it can be difficult to sort of assess the base value of that. And so again, one of the things that we actually help with is how people come in, sort of put data into our system. We'll find patterns in that data, will help make predictions, and we'll find bias. And I think there's kind of two things that are interesting to me. Number one, you had this explosion of alternative data in the 2010s, but a lot of them still haven't been around long enough for a machine to actually learn good things from it. And so I think over the next decade, what's going to become fascinating is a lot of these more alternative data sets will start to get enough history that you can actually start to build really, really sophisticated models from it. And I think that's going to be a fascinating development. I think the secondary thing I'll say is a lot of data vendors today don't really understand the financial space. And so they'll come in, they'll sell a model, and then a lot of times the people buying it don't actually understand some of the quantitative implications. So to give some examples, there's a lot of data sets that only have active tickers, that only have companies that are actively traded. And the problem with that is if you miss all the companies that went bankrupt or got bought out, the machine is going to sort of naively assume, oh, if I have this data, I'm not going to go bankrupt. And that's not actually true. It's just a problem in the data, your historical data. So you'll build this beautiful backtest, turn it on live, and it'll collapse. Or you might have a problem with cheating data, where they'll say, you know, we saw this on January 1st, but in actuality, there's no way the market could have seen it until a few months later. And so all these things just kind of compound it, right? Because if you don't know about these problems ahead of time, if you're not scanning for it and looking for these types of biases and trying to actively fix them, you can build these beautiful back tests. It might look really good. You'll go out, you spend, you know, a few $100,000 on this fancy dancy new data set, and then it doesn't work at all live. And, you know, the sort of tragedy there is it might have actually been really valuable if you had figured out these problems ahead of time. So I'll just kind of comment and say, it's going to be a major area in the financial industry. It's massively growing. People are starting to become more aware of these problems. There's more and more techniques to start solving these types of problems. And I think there'll be more opportunities to sort of leverage and sell data as the industry matures.
Melissa, adding on to this a bit. So we've talked about a couple of different areas where we can regulate AI. Which areas do you think are going to be most intensely the focus of regulation in the future? Because it's not just finance, but I would think things like healthcare would also have, you know, be high on that list of priorities.
Yeah, I mean, in some ways, I think aspects of finance and financial services actually already pretty regulated, and there are questions pending. The regulators have put out a request for information. Collectively, they put this out for the use of AI in the financial sector. And I think that's, do the laws we have in place right now, are they sufficient, or do we need to be thinking about how we evolve them, both for the benefits of using data and AI, but also for potential attendant risks? We co-hosted a conference last year with the Federal Reserve Bank of San Francisco on data and analytics, largely focused on data. And we had in folks from the healthcare sector and looking at, you know, what are existing protections, especially with respect to data and its HIPAA by and large. And then we had the education sector in, and it was actually quite striking, sort of the lack of laws and regulations around the use of data and the analytics in those other areas. And those are obviously, you know, highly sensitive. I mean, you think about, you know, data on you know, education, higher education financing, that I would expect there will be increased attention, is, you know, especially this administration is coming in and thinking about many of these questions very much from the consumer protection angle.
Yeah, on that front, you mentioned the new administration. I see, Jeremy, do you have anything to add on how like DC's views on regulation might have changed given this this transition? And it might still be a little bit too early to tell, but what signals have you guys gotten so far?
I think it's pretty early. I mean, I think if we're being honest, in the ETF world, all the regulation that people care about is like, when will they launch a Bitcoin product? I've got my hat in the ring on that one. But that's the most important regulation the ETF world cares about at the moment. But you know, there's a new SEC chair, and there's a new you know, they got to hire some new people, but that's the regulatory question in the ETF world.
One other good question on this too is Maxine Waters, House Financial Services Committee Chairwoman, has essentially issued 2 task forces on fintech and AI. And so what may be coming out of those task forces? Is there any potential legislation on this sort of coming down the pike? That'll be an interesting one to also make sure to pay attention to.
Yeah, switching gears just a little bit, because I know we're coming up on time now. Another good question in here that I see is, how would investments, including life insurance, be part of machine learning? Josh, do you want to take this one?
Yeah, I guess the only maybe valuable thing I have to add here is just you have to be very careful in domains like this, because oftentimes there is bias in the underlying data. And if there's bias in the underlying data, any machine learning system you build is going to replicate that. I mean, just to look at a specific example, not life insurance specifically, but related to this, Microsoft released this bot trained off of Twitter data, and it very quickly started to spew racist and, let's say, other unsavory verbiage. And that was because there was a lot of racist and unsavory things on Twitter for it to learn from. And I think in the same kind of way, you know, if I'm trying to figure out life insurance premiums or who should qualify or who doesn't, if there has been some systematic bias in the way it was done in the past, or it's just the underlying data that the system is learning from, that will be reflected in the machine learning model. And in fact, it might not just be reflected, it might be amplified a little bit, right? If you tell a machine learning system, your goal is to optimize the premium to get the best return, and it figures out that there's a few examples where there was racial bias and, you know, it got a better return when it was incorporating racial bias, it might actually do a worse job and be more discriminatory than a human is. And so, you know, explainability and those sides are part of it, but just because you know that your model is, you know, being discriminatory in some way, shape, or form, doesn't mean you've solved the problem. I think you actually need to, on day one, be constructing your model in such a way where, you know, simplest way is just to build in some heuristics that sort of hardwire and prevent it from doing certain types of discrimination. But there are machine learning techniques that have been used in other domains, such as recommender systems that also have to fight this bias problem. And the same sort of mindset should be incorporated if I'm building a life insurance system. I need to be thinking right from the beginning, what are discriminatory actions I want to specifically prevent the model from doing? And I need to be building the model from the ground up to prevent that. So I can't speak too much about how the industry is actually approaching these problems, but I'll say if I was in charge of building a machine learning system that was not discriminatory, this is how I would think about it for life insurance.
If I just make one quick comment there, the investment side, in a lot of annuities, there's sort of the underwriting of the annuities at the insurer. There's also like, what do the annuities provide exposure to? And just sort of like ETFs are looking at more sophisticated ways of getting investment indexes. Annuities, the first annuity incorporating AI was launched by actually an insurer that WisdomTree has worked with in the past on some other index products. And I think it was using an IBM Watson type algorithm, and there's been some ETFs tied to that same index as well. So I actually think this is a area, and from conversation I'm having, I'm hearing interest in exploring incorporating AI into annuity products. So just like any other index concept that's out there.
And I will add on, I know it sounds a bit like a sort of a one note here, but you know, I think the insurance sector is looking for some guidance and probably ideally regulatory blessing in terms of the machine learning algorithms that they would use for underwriting. And it's putting important but significant pressure on the regulators to know and better understand what they can, how they can sufficiently understand how the models are actually working, where there may be bias that are being created. And it all comes back to this question of, you know, which models are explainable and in particular context, and are then the underwriters able to assess themselves for potential disparate impact implications, and then correct for it. And it just really comes back to this need for understanding what those models are doing and the ability to calibrate accordingly in terms of what you're seeing and what the data are. But the industry is looking to use, but also wanting to make sure that it's on the right side of the regulators when they would go to deploy it.
On that note, that will wrap up today's panel. Thank you, Melissa, Dan, Jeremy, and Josh for joining me. And thank you to Rise of Barclays and Boosted.ai for sponsoring and hosting this event. This has been fun. I walked into this conversation not knowing much about what's going on in AI. So I definitely learned something in this conversation, and I'm sure that those tuning in did as well. Thank you, guys.